Hello and welcome to Business Incorporated live on Channels Television. It's another trading day, but we're focusing on something else. Here's what's coming up. It's rate setting season and Nigeria's Apex Bank's Monetary Policy Committee decides, would it be a hold, a hike, or a cut? Yes, that's our focus today. But we'll still check on some of the commodities that we track and some of these other markets. Now, we've seen oil prices edge higher today as markets weigh reports of mediation efforts against fresh attacks exchanged by the U.S. and Iran, as well as threats of a naval blockade of Saudi Arabia by Yemen's Houthis. So we're seeing Brent crude there. Did rise earlier about a big jump. 1.36%, $90.42. It's what we're seeing for Brent crude. WTI, 1.59%. So we're seeing a big jump so far. With natural gas at about 0.52%, $2.88 at this point. So, definitely we know how this impacts the pumps and government revenue, but more focus is on the pumps at this point and what it does to inflation. We're still trying to tame inflation in major economies at this point. So that's the latest reading right there. Escalation leading to higher oil prices. Let's get a check on metals now. Gold prices also rose today as investors are also weighing diplomatic efforts to ease the U.S.-Iran conflict, which could temper, oil-driven inflation. And we're seeing the safe haven. Yes, that's a safe haven we're normally used to, apart from the U.S. dollar. 1.21%. Spot gold, $4,064 per ounce. Spot silver, that's a bigger 3.68% advance. Platinum, 2.18%, $1,638 per ounce. And palladium, 1.09% higher. Copper, also rising big there at 2.96%. So that's the color right there for the metals market. So we're seeing oil, metals rising at the same time. That's not the usual at this point. Normally when you see oil up, gold goes the other direction. So it's supposed to be an inverse relationship. But now we're seeing both moving up at the same time. All right, now let's flip over to Europe quickly. Let's see what's playing out in Berlin. Definitely it's a different show today. The focus is the Monetary Policy Committee. We have Lars Holter right there in Berlin. Great to have you, Lars. How's it looking over there in Europe, looking at the markets?
Yeah, Ladi, good afternoon. It's good to be with you. Well, I can tell you markets here in Europe are up again on Tuesday, but only really by fractions. We see them up, most of them about 0.2%. We see France actually barely moving, just up a fraction or so. And so we can clearly see there is a really pressure on the market, even though they are trying to overcome it. So the little bit that we are seeing in terms of green arrows here on the wall is not really something you want to really bank on. The most interesting market in Europe today is probably London, and they're up a tad more, over 0.5%, and they're benefiting a bit from the fact that Andy Burnham now is the new prime minister, and he had in the past advocated for higher spending, specifically higher military spending, so that helps that particular sector. It has some of the British stocks a little further up, but the mood here on markets in Europe, Lali, is not really enthusiastic at all.
Yeah, definitely. That's been the picture, most of, from last week into this week. But are there any other, hot stories right there in Europe we should be looking at?
Well, we don't really have much of the big stories here. We're looking a little bit into a trade story. We have some new threats coming out of the U.S. or so that has the EU worried a little bit. We're talking about the healthcare system there a little bit, and I think we can get a little bit more into that tomorrow or so, because we're still getting our facts straight here. But we're just seeing trade weighing on the stock market, as well as it always is, of course, when we hear something from the White House.
All right, definitely be looking out for all those sound bites. Thank you so much, Lars Holter. We'll definitely see you tomorrow. Thank you.
See you then, Ladi.
All right, there you have it. Still the same picture. Investors looking out for comments, especially from the U.S. at this point, trying to look for some de-escalation at this time. But I did tell you, it's all about monetary policy right now, rate setting season. But let's see how it's been on the continent so far, talking about interest rates and inflation direction. And to help us unpack that, we have Ini John McQuarrie. You did see her earlier today on Business Morning. She's back again.
You have to look at your schedule to remember my name. I don't know if that's
really.
I don't know if that's a good or a bad thing.
I can never forget your name.
Well, Ladi, I mean, we've seen global disruptions,
right?
But it seems like a lot of economies on the continent have been able to manage it well. So we've seen, in spite of that, inflation sometimes decline in some of the major economies, and one would have thought otherwise when you think of the impact that it's going to have on emerging economies and everything like that. But it seems there's some shock absorbers that some African economies have been able. Even Nigeria's inflation, yes, it increased, but it was really slight.
Yeah, an easing, they've called it an easing, at this point, but it's not so much,
I don't know about the easing, but I know it's not much.
But it's still, on the high side.
Yes.
That is fine.
Anyway, so good afternoon, everyone. Let's see what's happening in other major economies and what they are doing with their rates, their MPC meetings in recent times. We will start with Kenya. In Kenya, we see that the country maintained their monetary policy at 9.75%. There you have it, at 9.75%. Inflation eased in Kenya. It eased to 6.4% from 6.7% in May. That's the earliest, or that's the latest inflation number that they have. The foreign exchange reserve, we see it at $14.05 billion as of July the 2nd. For Kenya. So we see, when you talk about inflation in Kenya, major drivers are food and non-alcoholic beverages, transport, logistics, that takes about 16%, housing, water, electricity, and other fuels, that also has fed into that. But they've been able to manage this in spite of the disruptions, especially energy cost. We've seen even Europe, everywhere, the United States, they're feeling the pinch of energy costs, but they've been able to manage that and then they recorded an ease in inflation in the month of June from 6.7 to 6.4. Then we move over to Angola. Angola inflation also, we saw that's also eased. I think African countries are learning some lessons and managing or adopting some lessons which they are not saying in words. So we saw that for Angola, annual inflation fell to 10.1% in June from 10.9%. It might not be so much, but the fact that it's not increasing in spite of all the global disruption is something to be taken note of. The slowdown has been supported by a more stable currency, the Kwanza, easing price pressures across key consumer categories. And so the interest rate we saw, that's also at 15.75%. That's what they kept it at. They had a 125 interest rate up. That's the MPC, the second consecutive rate cuts that they've had. That's in Angola. That's an oil-producing country. So perhaps they've been able to live without the Strait of Hormuz, and so they're able to shield themselves from the impact. And we see that also showing in their foreign reserve. The foreign reserve at about 17.3 billion as at the end of June. And of course, that provides a strong external buffer supported by oil export earnings. So they have been doing more of exports. So high prices of Brent and oil is good news for them. We move over to South Africa. That's what we see, a bit of what is happening in Nigeria. We see that annual inflation there increased 4.5. We don't have the data for June yet, so we have the one for May, and it increased to 4.5% in South Africa from 4% in April. The highest reading since July, and its energy costs. So we know that South Africa, well, it used to be the most industrialized, so I guess they're most connected to industrialization and the story around there. So they felt the energy cost, and that increased their inflation rates. Their reserve, we see, they kept the repo at 7% as at May. That's the last decision. We're still awaiting decision, the latest decision following June inflation, which hasn't been released yet. And then we see that their foreign exchange is at approximately $69.8 billion at the end of June. Ghana, next door to Nigeria, their inflation also rose. But I must commend Ghana. Since they started their domesticating gold program, they've been recording some wins, and dealing with their inflation, and their reserve has been looking really good. But they had, for June, they had an increase in their inflation from 3.7 to 5.3. That's a whole lot. It's a huge move right there. That's for Ghana. And then the monetary policy is at 25%, and their reserves, $12.1 billion at the end of June. So perhaps not as bad a picture as the world thought that Africa would be, with all of the disruptions going on at the Strait of Hormuz between the United States and Iran. It does seem like major African countries are learning some lessons on managing their economies even better, even though, of course, there's still a lot of struggle with debt and all of that. But at least it's looking good, laddie. So, not so bad. Right. Even Nigeria's inflation, yes, is high, but I mean, one would have expected that the impact, from what's going on would affect Nigeria even more. Right. Our reserve is good. We're doing 40 billion for nets.
That's for nets.
Yeah,
quite interesting.
For nets.
I remember when that was about 3 billion at some point, then moved over to about 22.
And then there was argument as to what's the real status of it.
Yeah.
So, laddie, we should lift our shoulders up. Right. That our monetary policy authority is working.
They're working, right?
Yeah, and that's why we see the naira. I mean, it could be at a better rate, right. But I mean, we've had this at about 1,003, under 1,004. Stability. For months now. So it's predictable. There's certainty for the market and investors.
Right, but you know me, the Oliver Twist in me.
You want more?
I'm still waiting for that 600 naira to the dollar.
Oh my God.
At least.
Keep the waiting on. Keep the waiting on.
Catch more,
yeah.
Gains to that dollar.
Yeah.
Thank you so much, Annie, for the details.
Thank you, laddie.
And I did say it's all about rate setting right now, and what to expect, for the Nigerian economy. And this time, we know there's a lot, the MPC would have to, look at when it comes to the US-Iran war and how that's impacted energy prices, and also the fears of it stoking inflation even higher. We'll take a break now. When we come back, we're going to head straight to the meetings. Oh, good afternoon. Welcome to our special live coverage of the Monetary Policy Committee decision for investors, businesses, households. Today's announcement could determine, borrowing costs, saving returns, exchange rate expectations, and market sentiment over the coming months. And before we get into our panel, let's do a throwback of what happened at the last meeting. David, that was in May, and it was a whole decision. 26.5%, that was for the MPR. We see the CRR for deposit money banks was at 45%. If you can put that up for me, merchant banks 16%. That's the last MPC May decision. Liquidity ratio, that was at 30%. Standing facilities corridor, there plus 50, negative 450 around the MPR. And definitely we've had inflation. That's for the month of June. It showed that inflation eased. That was for the month of June. It eased slightly, not as much as consumers would like, but it's something at this point. And I guess the Monetary Policy Committee will also be looking at what's played out outside our shores and how that's impacting inflation and the decision they're going to make today. And joining me for this panel, we have Mr. Paul Alaje, Chief Economist, SPM Professionals, right there in our Abuja studio. And right here in Lagos, we have Adedoyin Wilson Diamond, Executive Director, CFG Africa Limited. And they'll both help us today to unpack what's going to happen and when it happens, how that impacts the markets going forward. Great to have you.
Thank you for having me.
Good to have you, Mr. Alaje, also. But you know what, let me kick off with Mr. Alaje in Abuja. Definitely it's another day, another decision, and definitely we're going to take stock of what's played out so far from May, till now. It was a whole decision, consensus, and again, it's consensus today. What are you seeing?
Thank you so very much once again. If you look at the last decision, I think it was apt that the Monetary Policy Committee held rate because as of that time, even though the American authority and looking at external factor and that of Iran had agreed to cease fire and that they were going to watch that for a couple of weeks, and later they even had that they were going to observe it for a couple of months. But as we speak today, imagine we have made a decision on that agreement as a result of external factor, and you see what we have seen, a fresh escalation had happened. On the second hand, Monetary Policy Authority has also observed what is happening to inflation. One of the things we hope that monetary policy rate will curb is inflation because of inflation expectation. We have seen that even though just after that meeting, inflation went up slightly and is back, he has retreated a little to about 15.91% year on year. And this was from June report. But it's important for us to look at what is happening to the rest of Africa. Ghana had its own about 15.5% because inflation, when you look at the inflation number in Ghana, is about 8.7, around 8.7 thereabout. South Africa monetary policy rate is about 7%. Inflation is about 5.2%. Go to Egypt, 17.75%. But look at inflation, 14.3%. Go to Angola, 18%. Inflation about 10.11% as of June. Then when you go to another nation, I think Ethiopia, 15%, and when you look at their inflation rate, it's 13.4%. If you go to okay, I mentioned Angola. Look at this key nation, including Kenya. Kenya is about 8.75%. Inflation rate of June was 6.41%. Of all these nations, you see that monetary policy rate for Nigeria is higher. But one thing we also need to look at before we start criticizing Monetary Policy Authority is what is their inflation number. Nigeria inflation number seems to be highest among, I'm not saying it's the highest in Africa, but among the selected countries that play key role. Some of them oil producing, some of them partially industrialized, some of them within our region, they've been carefully selected. Nigeria is 15.91%. What that means is Monetary Authority, we need to take a cautious decision. The optimism we have seen, one, we have seen relative stability in exchange rate. Naira has remained around 1,300, 1,400 for a longest period of time in the new dispensation. And that is commendable compared to the instability that we have had. Yes, I know a lot of Nigerians want it to be 1,000. Personally, I want it to be much more better than what we have. But we need to first know that we are within the stable environment right now. And beyond this stability, we also need to look at what is happening to our reserve. If you compare reserve of this nation, which I mentioned to you, look at Nigerian reserve at about 51.3 billion. Ghana, 11 to 13 billion. If you look at South Africa, over 70 billion, over 76, 77 billion. If you look at Egypt, 53 billion. What you need to compare quickly is what is the population, what is the requirement for import. Compare all of this. You know that Monetary Policy Committee in Nigeria needs to carefully look at the numbers. And when they look at this number, they will now they will have the need to see how to possibly adjust or increase or decrease as the case may be. But for me, if you ask me a direct question of what should they be looking at for this Monetary Policy Committee, I will tell you that the rate will be important, and what will that rate be? It will be to hold. Even though if they decide to cut, you see that maybe we are targeting inflation, but we know that the marginal reduction and that several factors that are considered, several factors, which includes what is the expectation for inflation, which includes what is the external factors, that's geopolitics, how it's affecting us. We are seeing new phase of escalation. We cannot predict whether there will be an end to that, knowing fully well that elections are coming. These are now political factors. Elections are coming. And when election comes, what comes with it is political spending. I remember that about 3 or 4 MPC ago, the central bank governor had also said he would want politicians to cooperate with the central bank, right. And I'm paraphrasing his word, because they don't need to create unnecessary inflation. Because when they spend without this spending affecting productivity, it will definitely fuel inflation. So as we are moving closer to election period, and INEC perhaps will be lifting the ban, we need to be very careful.
Right.
This will impact our economy directly or indirectly, and you have implication on what inflation numbers will be.
All right. We're definitely already getting live feed there right from this MPC meeting. I believe this is the 306th one at this point. And the governor is seated at this point, and very soon he will tell us the decision. And investors will definitely be listening out for forward guidance at this point. What's going to happen next for the rest of the year? And maybe, is it going to be hawkish or dovish? We'll definitely find out. But let me come to you, Adedoyin, at this point. I'm imagining you're in the room right there. What are you voting?
To hold. And the reason why I would say to hold, just to follow up on the conversation that the doctor spoke about, is FX. FX has been the core for the MPC this year, has also been the core for CBN this year, and they've done a very good job. We should applaud them. We're making sure that FX is stable. We've seen our reserves grow. As of end of May, we had 49 billion in our reserves. As of the 16th of July, we're at $51 trillion in our reserves. That's commendable. That's
$1 billion.
$1 billion, sorry, in our reserves. That's commendable. So that's one reason. Another reason is also inflation. Inflation has kind of been stable. Just as you mentioned earlier, we've seen a drop from May to June from 15.93 to 15.91.
Yeah, that's slight.
It's slight, but it's needed. It's needed, and right. it's a sign that they're doing the right thing. So when you look at that, and also look at global crisis. As of June, we were thinking that, okay, there will be a ceasefire, there will be peace, but now it's escalated. Any drop in MPR right now could send shocks into the market, and we do not want that. So it only makes sense to just hold it. And if we're being sincere, we really haven't seen, we didn't get to see the implication of the cuts in February 2026. We haven't seen that, because right after we went into the war. So we still need to think about that. So it only makes sense to just keep it stable for now. Right.
And at this point, talking about the war, I've heard speculations at this point, the U.S. trying to figure out an exit plan. We know how we started this war, but now we don't know how to end it at this point. But definitely that would be one of the considerations for this MPC. But for the markets, how do you think the markets are reacting right now up till this meeting?
I think it's general consensus in the market that we expect that MPR will be held at 26.5. It's general consensus. As I mentioned, FX is stable. We're seeing foreign portfolio investments in our market. The yields are quite high. They're attractive. You're seeing OMO yields at 21% effective yield. You're seeing bonds. There was a bond auction yesterday. It printed at 18.34 as an average. That's pretty good. And we're seeing traction in our market. Even the equities market has been buoyant. It was the best globally.
Yeah, 58.2%.
Yes. So
year to date, month to date, 7.3.
Exactly.
Quarter to date, 7.3. So it's still green.
It's still green. It's
Even
still
though
green.
June, we saw that big sell-off.
Yes, and that's understandable because you're closing the year, the half year. Everybody's trying to rebalance their books, but of course we're back up again. But yeah, I think market consensus is to hold it at 26.5 is what we expect. Anything other than that would be a shock.
Would be a shock.
Think, not just for me. I think for market.
What's the biggest shock? A cut or a hike? Is that the biggest shock? Which one could be the biggest one there?
I think the biggest shock will probably be a hike. And the reason why I say that is that coming into 2026, what we expected, and this is just even globally, not just in Nigeria, was a cut in rates. The Fed was looking to cut, Bank of China was looking to cut, even the Bank of the Eurozone was looking to cut, even Nigeria was looking to cut.
Coming into 2026.
Yes, and we had that cut in February, but all that changed because of the global crisis. So, yeah.
Right, which we're still trying to find a way out of at this point. But I know the governor would soon start his communique at this point. But let me get a word from Mr. Paul Alaje right there in Abuja. So, Mr. Paul, definitely the governor will be addressing us soon. Okay, I think the governor is speaking. He's speaking now. Let's go live.
The committee reviewed recent developments in the global and domestic economies, assessed emerging risks to the outlook, and considered their implications for monetary policy. 11 members of the committee were in attendance. Decisions of the MPC. The committee decided as follows. 1. Retain the monetary policy rate at 26.5%. 2. Retain the standing facilities corridor around the MPR at plus 50 to minus 450 basis points. 3. Retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and non-TSA public sector deposits at 75%. The committee's decision to maintain the current policy stance followed a thorough assessment of the balance of risks. Although the headline inflation moderated marginally in June 2026, global uncertainties have heightened due mainly to the renewed hostilities in the Middle East. In view of the evolving developments, maintaining a cautious monetary policy stance remains appropriate. Considerations. In arriving at its decision, the committee noted the recent resurgence of hostilities in the Middle East, with particular attention to its spillover effects on global energy prices and the potential pass-through to domestic inflation. Notwithstanding the development, available evidence suggests that the Nigerian economy has remained largely resilient to the external shocks, reflecting the gains from prior reforms implemented by the fiscal and monetary authorities. However, maintaining the current monetary policy stance will provide an opportunity to closely monitor incoming data and assess the trajectory of inflation to guide future policy decisions. The MPC acknowledged the federal government's renewed commitment to strengthening policy coordination, with particular emphasis on the ongoing collaboration with the monetary authority, which has helped to moderate the impact of the Middle East crisis on the domestic economy. Members thus noted that greater alignment between fiscal and monetary policies would enhance policy effectiveness and support the achievement of overall macroeconomic objectives. To further strengthen macroeconomic fundamentals, the committee underscored the potential benefits of Executive Order 9. Members further commended government's renewed efforts in improving crude oil production and encouraged relevant agencies to strengthen the implementation of reforms to maximize the potential in other sectors, such as solid minerals, to complement government earnings. The MPC welcomed the positive outcome of the banking sector recapitalization exercise, noting the improvement in the resilience of the banking system as reflected in key prudential and financial soundness indicators. It nevertheless urged the bank to sustain effective surveillance to preserve financial sector soundness and mitigate potential risks to financial stability. Price and other domestic developments. Headline inflation year on year is marginally to 15.91% in June 2026 from 15.93% in May 2026, ending the 3 consecutive months of uptick in price levels. The decline resulted from a decrease in the non-food component, which offset the increase in food inflation. Food inflation rose to 17.52% in June 2026 from 16.96% in May 2026, reflecting supply constraints in major food producing areas and elevated transportation costs. However, core inflation moderated to 15.92% in June 2026 from 16.82% in May 2026, largely on the back of exchange rate stability. Similarly, the 12-month average inflation rate sustained its decline to 17.63% in June 2026 from 18.36% in May 2026, marking the 6th month of consecutive moderation and reflecting a slower pace of price increases over the medium term. On a month-on-month basis, headline inflation declined to 1.66% in June 2026 from 1.75% in May 2026, driven by a slowdown in core inflation. Real GDP expanded by 3.89% in the first quarter of 2026, compared with 4.07% in the preceding period. This was largely driven by the resilience of the non-oil sector, which grew by 3.94%, supported by improvements in telecommunications, financial services, trade, transportation, and other services subsectors. Oil sector GDP growth rate declined to 2.57% in the first quarter of 2026 from 6.79% in the fourth quarter of 2025 due to the maintenance of oil facilities and installations. However, recent data showed improvement in economic activities as Composite Purchasing Managers Index, PMI, rose to 50.1 index points in June 2026 from 49.6 index points in May 2026. Gross external reserves rose to $52.52 billion as of July 17, 2026, from $50.47 billion as of end of May 2026, mainly as a result of receipts from crude oil-related taxes and third-party inflows. This is sufficient to finance approximately 11 months of import of goods and services, surpassing the international benchmark of 3 months cover. Global developments. Recent estimates indicate that global growth is anticipated to slow to 3% in 2026 compared to 3.5% in 2025, reflecting the impact of heightened geopolitical tensions in the Middle East, trade policy uncertainties, and tight fiscal conditions. Risks to global inflation remain on the upside, driven mainly by the increasing prices of crude oil and other commodities. Inflationary pressures are likely to be further amplified by supply chain disruptions and climate-related shocks inhibiting food production. Additionally, exchange rate volatility and fiscal constraints pose upside risk to inflation in most emerging and developing economies. Outlook. Output growth is projected to remain resilient in 2026, anchored on the recent improvement in crude oil production, expansionary Purchasing Managers Index, and the positive impact of timely policy reforms. Inflation is projected to moderate further in the medium term on the back of continued stability in the foreign exchange market, lagged effect of previous monetary policy tightening, and improved food supply conditions as the harvest season approaches. The key risk to the outlook, however, remains the severe and prolonged escalation of the Middle East conflict. In the light of these considerations, the committee reaffirmed its commitment to preserve price and financial system stability and remains prepared to take appropriate policy measures guided by evolving macroeconomic conditions. The next meeting of the committee is scheduled for Monday 21st and Tuesday 22nd of September 2026. Thank you.
Thank you, Mr. Governor, sir. That was communique number 163, presented by the chairman of the MPC and the governor of the Central Bank of Nigeria, Mr. Olayemi Kadusu. As usual, we take questions from members of the press. Please, when asking your question, state your name and don't forget your medium and then ask your question. One question each. Thank you.
Thank you very much. I don't know about one question, but good afternoon, Governor and members of the MPC. I'm Nancy Naji, Moneyline with Nancy on AIT. Governor, let's take it from where you ended your speech. You talked about headline inflation. It's been virtually flat, at least the last 2 months has shown us that 15.91% in June, or 15.93% in May. And we've seen inflation hover around 15 to 16% for the last 4 months. I'm wondering if that is a comfortable play too for the central bank's MPC looking at it, because I heard you clearly earlier on when you talked about you do everything possible, So I'm actually wondering, with the supply side risk we're seeing from the Strait of Hormuz situation, global energy pressures also adding to what we're having here in Nigeria, how is the CBN going to tackle headline inflation? And if you're still on the trajectory of single digits, so because inflation, that's where it hits all of us, is the thief that we are all chasing. And the side parts, congratulations for the international recognition, Central Bank of the Year. Let me just give you that, so congratulations.
Well, thank you very much, Nancy. Again, I think it's appropriate to remember where we're coming from. 11 months of disinflation, and quite frankly, from every indication, we were expecting that by early 2027, we would be where we want to be in terms of inflation and, firmly on track for single digit. Unfortunately, as you know, and you said it, these were shocks that came that, were not anticipated in that manner, and has gone on a lot longer than could have been anticipated. And really and truly, at this stage in the game, who knows how long that is going to be. So it's not something we can wish away. It's just something that we need to deal with. We are pleased, however, on 2 counts. One is the fact that inflation has moderated, albeit slightly. It has moderated. Headline has moderated. So that gives us an indication of the fact that the tools that we have implemented so far are bearing effect. They are bearing effect. Secondly, and you're absolutely right, there are rigidities, that these are all rigidities that really and truly hit you from different sides. Collaboration between the fiscal and the monetary at a time like this cannot be overemphasized. And we intend to deepen and strengthen that collaboration such that we are alive to the responsibilities. And as I said, we will do what we need to do to ensure that we can contain rising inflation in any manner and bring it to the single digit that we have said earlier, and we still continue to stand by that. On the other note, I thank you very, very much for your kind words with respect to the Central Bank Award, Central Bank's Global Award for 2026. And a couple of things I think it's important to say here. One is that if you recall, for those of you who may have followed, I was very clear in dedicating that award not to the central bank governor, but to the staff and management of the bank. I felt, and I do feel, that that was a very, very important thing to do, because I understand fully that a lot of the very, very hard work that has been done by the central bank has not been done by the governor on his own, but has been done by the whole bank. And at times like this, when these recognitions come, it is important to sit down and reflect on the road of travel and why we are being relatively more successful and recognized internationally, by the way. This is not a local recognition. And one of the things I said when we received that award is that, you know, the responsibilities of central banks around the world are a very solemn one. They are a very solemn one. What do we mean by that? We mean that they are a very serious one. It's not something that you take lightly, because the decisions you take impact millions of people, and in our case, hundreds of millions of people. So those who are dedicated to the cause, who are working behind the scenes to ensure that the central bank is living up to its expectations, need to be recognized. The other important thing from that is the resilience of the Nigerian people. The resilience of the Nigerian people. This has been a hard and tough journey. It's not been easy by any stretch of imagination. And I know that sometimes I get asked the question that how does that percolate? And you are one of those that have asked me that question a number of times. How does that percolate to the man on the street? Now, if you watch, you will see that one of the most fundamental shifts that has taken place over the past couple of years is the stability of our system. Now, without that stability, you don't get investment. And without that investment, you don't get the growth that we need. So, it's been so important to ensure that we worked hard to get that stability in place. And that is forming the platform for the greater growth in our economy. Reserves have been up. As I said, the stability is there, and the resilience is gradually paying off. So I thought it was very important to mention that. And then finally, I think one message that certainly I have gotten from this, and I would encourage everybody else too, is the fact that we are not an island. We are not an island. We'll be making a mistake to think that the things we do are not recognized and are not monitored by the rest of the world. They are. They are. And all the very difficult and painful reforms we've made, which were eloquently spoken about during the awards ceremony are ones that have been tracked by those who make it a point of duty to do so. And they can see that those reforms have taken us to a journey that is paying off for Nigeria, and as other things begin to cascade and join with this, I'm confident that there'll be better times ahead for the country.
Good afternoon, Mr. Governor, members of the MPC. My name is Nduka Chejin of the Nation newspaper. Mr. Governor, sir, the IMF recently said that the Naira is estimated, or a bit undervalued, estimated at about 1,142 Naira to the dollar. That's what they are saying. This suggests that the currency is about 25.6% undervalued. What is the position of the central bank on this? Thank you very much.
Thank you very much. Again, to say that our view is one of continuing on the path that we had embarked on, and that is to ensure that we have a market that is transparent, that is liquid, and one that has willing buyer, willing seller. That's it. Now, where that price settles, and again, don't forget that these are the price is a moving target. It's a moving target, and where that price settles is a function of a number of different things. Where it eventually settles is one that cannot be done without fundamentals kicking in. Without fundamental kicking in. Oil and oil exports, FDIs, domestic productivity to reduce imports, all those things need to kick in. But we are very comfortable at the central bank that we have a fully functional market, a market that is open, that is transparent, a market that sometimes you find that on a daily basis the amount of turnover is in excess of 1 billion US, and a market that is responding to the positive things that we are doing as the central bank. A very important issue at the present level, the country does need a competitive currency, and from every indication, the levels in which they are move for competitiveness. Thank you.
Good afternoon, Mr. Governor. Good afternoon, everyone. My name is Musa Abubakar with NTA. The Central Bank of Nigeria recently launched the Nigeria Overnight Financing Rate in collaboration with Financial Marketers Dealers Association to provide a kind of credible benchmark for the financial market. What does this mean for the economy, and how does it support effectiveness of monetary policy? Thank you.
Thank you. The NOFA is Nigeria's official overnight risk-free rate benchmark. It reflects between banks, it reflects the cost of overnight secured funding in the Nigerian interbank market. Now, why is that important? Why does that matter? Because really and truly, it reflects two things. One, it reflects greater transparency in how that particular rate is determined. In the past, we had a situation where banks would simply give a rate that they believed should be reflective of what interest rates should be. That has now, we've now done away with that. This system ensures that the real transactional rates, as opposed to judgmental, are the rates that are being used. That's very important. And I would also not hesitate to say that that is certainly something that has, we're not the first ones to do this. We're taking ourselves up to benchmark world standards. The UK, for example, has long moved away from LIBOR to SONIA, and so has the United States. So we are basically going into a more, we're getting in line with the international benchmarking standards. Going forward, of course, we expect that there'll be greater synergy between the MPR and NOFA going forward, and that MPR is a benchmark; it's a general benchmark rate, but the NOFA, it will give you a clearer idea of exactly at what point transactions are being executed. And indeed, going forward, as we go down that road of inflation targeting, it will be a key ingredient to plug into that inflation targeting framework.
All right, there you have it. That's the latest one. We've all been holding our breath, waiting for that, I guess, maybe some of us at this point, but it's the same thing, just like the May meeting stuck at 26.5%. Other parameters left held there, and definitely the governor did unpack a lot of things. He did talk about the purchasing managers index there at 50.1%. That was a positive for him, getting back into expansion from contraction. That's anything below 50 points. Then we see the forex market still stable going forward. Closed at 1,380 naira. That was the last close there. Was up about 1 basis point. That's for yesterday, and the expectation is today's close won't be far from this. Then for foreign reserves, we're at 51.8 billion, which is approximated to about 52 billion. That's for the gross Nigeria's foreign reserves at this time. That's our buffer, which he said has crossed the 3 months cover. That's the global benchmark at this point. So a lot of positives there, but I guess the negatives were largely the shocks from the energy market, definitely the war in Iran. And he did talk about Nigeria's GDP for Q1, 3.89%, coming from, I think, about 4% in Q4 2025. So a lot to unpack there. And definitely, I still have my panel right here. But I'll start off with Mr. Alaje in our Abuja studio. At this point, what sentence in the communique matters more than the interest rate decision itself?
Yeah, thank you so very much once again. The Central Bank Governor had mentioned that in the coming period, Nigeria should expect more improvement. He mentioned that he expects inflation expectation to reduce. We are not expecting higher inflation, except and unless situations that are what we call externalities that are outside our control. We understand that global oil price, which of course have implication on energy, is completely outside the control of our nation. We also understand that excessive imports, even though we can manage it to some extent, but it may go to an extent where we may not be able to control. But what the authority is saying here is that for now, based on what we are envisaging, the nation is not expected to go to a period where inflation, again, will go out of control. That does not mean inflation is not high already, but it's good. You would recall that myself and the other panelists, the wonderful woman in Lagos, had mentioned that it's important for it to be held the same. And I must tell you that I think the central bank have taken a decision. It's not that they have not taken a decision. The decision MPC have taken today is really very significant, even though it might appear as though there is no adjustment. What they have not done is to cause uncertainty in the market. What they've not done is either to increase or decrease, which of course may result in a significant shock in the market. I think this decision is right, and I think this decision will also help us to see if we'll further withstand the shocks that may be coming from external markets. And I can tell you for now, the resilient level is appreciable because we have not seen major devaluation of currency since for months now, about 11 or over 12 months now. We have also seen inflation trend downward. Right now, according to the Bureau of Statistics, it's around 15.91%. We expect that number to further go down in the coming period. There may be some level of uncertainty as regards when we get to the last quarter of the year, and the reasons are obvious because of politics, but I expect that the next policy meeting, that's the MPC, the central bank governor and his team, will carefully study what the election cycle, this coming election cycle will look at, and they also have to take a position regarding that, because it's important for all the gains we've made in the last 1 year plus, we don't lose them to electioneering process.
Yeah, definitely. Thank you for that. I'll come to you now. Adedoyin, yeah, so he did give an outlook, CBN governor, and talked about output growth, being resilient. Inflation, he expected that to moderate further, but he did talk about key risks. That remains the escalation there around the whole Strait of Hormuz. We don't go a day without talking about the Strait of Hormuz at this point. But listening to this, I guess the markets will be okay.
Yes, the markets will be okay. What the entire communique has told us is that stability is key, and that's what we need. We need to be stable. We need to be stable because that would help our FX reserves. We need to be stable because that would help the market to continue to trade, right? We need to be stable in terms of FX pricing. All we need is stability. If I look at the communique from the 305th meeting in May and this one, it's somewhat of the same thing. Centers around three things.
Sounds like deja vu.
Yeah, somewhat of the same thing. Centers around FX reserves, talking about the global unrest. We already know that. And also inflation. And it's good to hear that inflation will moderate as we go into the year. So if it's not broken, don't fix it.
Don't fix it.
Don't fix it.
Right.
Just keep going.
So I guess at this point, at the close of trade today, for most of the markets, it should be positive.
Yes. Market has priced in a hold, an unchanged rate on MPR. So we're good to go. We just keep running.
All right, Mr. Alaje, let me come to you now. Definitely, he did mention the next meeting that's coming up. That's for September. What indicators do we watch heading into the next meeting?
Okay, a number of things we need to look out for. The first one is we need to look at headline inflation, as the release will be coming from the National Bureau of Statistics. Two, we need to look at our reserve. We're at a comfortable level now, over 51 billion. I expect that before September, that number should increase further. We should also be looking at the external factors, external influence. What is global oil price saying? We also need to look at Strait of Hormuz. Have we found a way out? Is the American authority able to exit the war, which is really very important? Or are we finding a solution? A solution. I believe that at this time, different leaders around the world should be looking for how to solve global crisis, especially this regional crisis, because it has implications not just in Nigeria, for so many countries that we have looked at in Africa. Very few of them have been resilient. We have seen even Egypt and a few other countries that have been affected partly because of the effect of this on Strait of Hormuz. Recall that Egypt is quite close to that region. And we also should be looking at, apart from inflation, apart from that, we also need to be looking at what effect this will have on trade. And generally speaking, we might think we are discussing monetary, but we also need to look at what authorities, fiscal authority will be doing, because this will, of course, affect overall economy outlook. Recall that central bank is part of the overall economic outlook, and they cannot work in isolation. And perhaps that is why when the governor was speaking, he gave credence to authorities, government, when he mentioned that he noticed that there is improvement in crude oil output. If this further increases, we might be creating foundation or background for a rate cut. But inflation still remains largely above 14%. If the reserve is still around 50, 51, 52%, if we still have uncertainty, which we have had in the last meeting and today's meeting, if that is still there, if we still have quite a number of other things that are not certain, even though we have some positives and they are commendable, I tell you that there is no point recreating the wheel. If you want to recreate the wheel just because you want to take a decision, nations that tried it, they have their number went up, and they are now trying to increase again. But for Nigeria, we have seen stability. People are able to plan, businesses are able to move, and I think it's the right decision to take. So we need to watch out for these parameters. If they are the same, also look at, before that time, we would have seen the half-year report of the GDP, we would have seen the Q2 report of the GDP. That will play a significant role. We also need to look at what PMI will be talking about. If the Purchasing Manager Index, if that will still remain above 50%, which I think it should. So all of these will come together to determine whether the rate will change. If the rate increases, there are reasons for increase in rate. Maybe we're looking at forcing inflation down. If the rate will reduce, perhaps we want liquidity to be in the system. And if the rate remains the same, we're encouraging the current level of stability. All the decisions are important, but it depends on what is priority for us right now. Priority for us as a nation is stability. Recall that if stability lasts for a while, stability itself is not a target. It is to make our nation prosperous. It is to make our people empowered. It is to reduce poverty in our nation. But the foundation is perhaps what we are looking at this moment today.
Right, and definitely from the communique, he did have, a lot of positives there. He did talk about, the risk and the outlook for the economy. But Mr. Alaje, if you had 1 minute with the governor right now, what would you ask him?
Okay, so if I were to speak with the governor, my conversation with him will be on how to work further on helping Nigeria to get to that $1 trillion economy. As I speak, even though we are not yet there, but what are the things that we need to put in place to ensure that we get to that $1 trillion economy? And that conversation will go beyond 1 minute. But I can introduce that is my conversation. I think that we should be looking beyond where Pakistan is today. We should be looking at beyond where India is. India reserve is crazy. It's not what I want to discuss right now. But I strongly believe that if both fiscal and monetary, as well as trade, actually, if the three authorities, we work together, Nigeria can achieve a $1 trillion economy in less than 10 years.
Right. Adedoyin, I'll come to you now. You find yourself in an elevator with the governor. What are you asking him?
I would ask him, I want to know what his long-term plans are. We have a lot of short-term plans on fixing things. Market is liquid. The market is extremely liquid. There's almost auction every week in the trillions. What are the long-term plans? We can't continue borrowing. Well, the government can't continue borrowing at the rate that they're borrowing. So I would like to know medium to long-term plans. Very, very important. So we know that we're actually on the right tangent to meet the $1 trillion economy that Dr. Ladi was talking about. Yes.
And talking about borrowing, at this time, every month, every week, we get some of those, the government goes to the markets, trying to get some money. And investors are ready.
Yes.
They're ready to give out that cash at this point. So I guess it's been a great first half for investors. But I guess borrowing costs,
very steep.
Still a big problem.
Very, very steep.
Right now. We're in H2. It seems that's going to continue.
They don't have a choice, and that's what I mean by what are the long-term plans. They have to continue to roll over those maturities as they happen, and they happen every single week. Today is Tuesday. There's a maturity today about 1.6 trillion that has to be rolled over. Now the bond auction has taken care of that. We've seen a debit of about 900 for the bond auction that happened yesterday, debiting tomorrow, but next week we're back at it again. There's another maturity. Investors are wanting to put that money back into the market. Right. The yields are very attractive. It only makes sense for you to borrow at those yields, but then again, the cost to the government is steep, pretty steep. So we need something, something firm, something long-lasting, as opposed to these short-term fixes.
And definitely, we've talked a lot about hot money.
Yes.
At this point, but it said you can have hot money for a while, that somehow it transcends into cooler money.
Yes.
Are we gonna get there this way?
That's where we need the that's where we need the FDIs. to come in. We actually need companies coming in and actually open up shop in the country, as opposed to just FPIs coming in and bringing in their cash. We need stable money that sits. What we have right now is all hot money. Right. If anything, towards the end of last year, we had a lot of international companies exit in the country because doing business in Nigeria is not child's play. But we need them back. We need them back, and we want them to stay, want them stable. So another question I've asked him, what are the plans to do that? Because hot money can only last for so long, and hot money is expensive money that we don't want on our books.
Right. Mr. Alaja, I did hear your reaction there. I'm sure you'd like to chime into that one.
No, I think what she said is so apt, is really very correct. I've been at the forefront of finding ways to discontinuation of borrowing. Borrowing seems really easy, especially when you roll over debt over and over again. But it's important that authorities, especially the fiscal and monetary authorities, converge. And we need, because debt matters affect both. It's not just for monetary, it also affects the fiscal authority. We need to find alternative. And in finding alternative, the question is, with this high rate, what are we using it to attract? The rate that is high will definitely attract more of hot money, just like she has rightly put it. It will attract portfolio investors instead of attracting the real investment in real sector. And I've said that for us to achieve this, we need the government to perhaps look in the context of this reform. What are the things that we are importing the most? If it takes us to be a bit to use our fiscal policy or fiscal reform to ensure that we discourage importation and encourage those who want to come to our soil to open their factory. How did China get to where they are today? Chinese people, the Chinese government did not just hope that people will come and invest. They hoped for some decades, but it never worked until they got electricity correctly in some region, not everywhere at the same time. So this one, Nigeria wants power to be distributed to the entire nation and everybody have permanent power supply. I doubt if that will work because I've been around for over 4 decades. It has not worked. So what is the advice? Is that Mr. President and his team, as well as the monetary authority, we need to look at key areas where production can happen. Make power available, permanent power supply with good quality and good quantity in those regions. That is equation one. The second equation will be build factory. Whether you are going to find support, lease it out at what people may not imagine. That is not what is important because that real estate is just one. Even if it has to be public-private partnership, lease it out, and what you do, you start getting revenue from company income tax, from personal income tax, from other taxes in those areas. Revenue will come, people will grow, the economy will expand, we're going to need relative stability. Private sector will take it up from there. With transparency and our anti-corruption fight, we're going to see Nigeria expand from one region. We can divide it into some geopolitical zones, some north and south, some west, east, some anywhere, anything. So divide it around. It mustn't be that everybody must grow at the same pace. It never happened in the last 4 decades. I don't think it will happen in the next 4 decades. What I think will happen, however, is can we look at somewhere in Kano? Can we look at somewhere in Lagos? Can we look at somewhere in Inewi? Can we look at key areas where production can happen, where you see that the environment already supports production? Then generate power locally in those areas. So you look at what would be the fact, is it nearness of power supply, is it nearness? One of those key things, then we make power supply relatively available, create infrastructure around those places, then create what may serve as order to investment. Revenues will come, Nigeria will grow, people will get jobs. It will contribute to GDP. Inflation will largely reduce, then exports will be substituted, imports will expand. Nigeria can also be a great nation, as we all want it to be.
Right, and talking about production and also China, at this point we've seen the EU and other countries complain about the unfair subsidies the Chinese government gives to their producers, which is allowing them to knock most of these countries and continents out of the market at this point. So I guess we need some kind of unfair advantage for our producers, you know, if we can get that. But let me come to you, Adedoyin. So we've been talking about hot money at this point. What if we decide and say, okay, you know what, we've made the yields attractive for so long, maybe we've done it for a couple of years, and we say, you know what, they're no more attractive. What's the worst that will happen?
If we do that, the first thing you're going to see is the FX market to go upside down. We're going to see a reduction in our Federal Reserves. Now, during the MPC and the communique when the chairman was, the governor was speaking, he mentioned an increase in our Federal Reserves. That's largely due to the inflow of these hot monies. The hot monies are coming in to buy securities at really high yields. They're coming into our equities markets, very buoyant markets. That's where the money is coming in from, in all truth. Aside from that, there have been conversations and there have been transactions with other countries. I know there was one with Abu Dhabi, where a bond was issued and about 2 trillion or so was taken in, borrowing. That's all the things that are causing our FX reserves to go up. So if for whatever reason we decide, you know what, we're going to drop the yields, there'll be reaction in that case. Now, before we do that, we need to solve the real issue so that we can have money that stays. And reforms need to happen. There need to be reforms. I remember during Sanusi as governor, there was a reform regarding when to come into the market and when you can exit in terms of investments in the Nigerian economy, and this is for FPIs. We might need to start looking at something in that regard, and I think it will work because right now we have everything looking good. It's quite stable. We have a government that understands how to keep our FX stable. They're able to come in, give them maybe a 90, 180-day window after which you can exit, not really coming in and doing proper trade and making income, right? And then exiting our market and coming back in when it's safe for you. But we need to have reforms in place. We need to make sure that at least we already have some FDIs in. We already have companies set up in the country before we start thinking about, you know what, we're going to drop the yields. And also, we can't necessarily drop the yields without looking at the global economy at large. One of the major reasons why Nigeria is very interesting globally is because our yields are very attractive. Our yields are attractive compared to other countries, compared to their own countries. Do you understand? So we need to look at that also. If their yields are dropping, yeah, we can drop ours slightly also, but it can't be too far off, because if it's too far off, they exit.
Right. It's almost like choosing between the devil and the deep blue sea. Almost sounds like that.
Yes, it does. We need the FX.
Right. All right. Mr. Alaje, at this point, we've had this meeting. It's done. It's another hold as expected. What needs to happen now on the fiscal side so we can all somehow make way?
Well, what we need to do right now at the fiscal side is to ensure that the approved budget releases go to contractors, and we look at financing the key sector. Clearly speaking, the Monetary Policy Authority are confident about their own leg of the economy, which is how to combat inflation, how to ensure that the rates are the same. They know what they know how to do. We just saw it on your screen. But the fiscal harm, which is, of course, the impact of whatever they do, inflation and all of those, it comes down to everybody. What we need to look at is the real sector. At the end of the day, if yield comes down, you are going to see that reserve, the immediate effect, depending on the percentage, it might be as high as 1/4 of what was announced, about $51 billion. 1/4 of that may be wiped out in 1 year if yield come down significantly. But what will save us is a fiscal authority. That is, our contractors, are they paid as at when due to the key agencies of government? And I will highlight 3, not that the 3 are the only ones that are important. I'm talking of, first is energy sector. How many are we able to generate? How many are we able to distribute? Secondly, the Nigerian Railway Corporation. For the rakes, are we able to bring in new tracks, as well as to build new tracks, maintain the existing one? Those of them that are due for service, are we able to fund the Nigerian Railway and also provide new coaches for the Nigerian people? Thirdly is general infrastructure. And I must give it to different states now. I've seen some road works going on. I've seen in FCT, I've seen in Lagos. I've seen a few places where new construction, amendment of some others are going on. But when you look at that in relation to what we need as a people, you know that we need much more. But I think that is going on. Revenues must be given to contractor in this key sector, and without forgetting all other sector, education and health. But the key one here is that releases must go to contractors because they are private sector people. That is how we can say that the impact of government spending reaches the people. But when we budget and the releases are not going to the people, as at when due, you see that the impact will be worrisome, and we may have multiple budgets running at the same time.
All right, Adedoyin, at this point, what should the investors look out for before the next meeting, or what should they also be doing?
Before the next meeting, pay attention to inflation. I would actually pay attention more to core inflation, and I'll pay attention to food inflation. As the governor mentioned, we're expecting the food prices to come down as we're getting into harvest season. So we expect that would trend down a little bit and then largely affect headline inflation that will also trend down. Pay attention to market liquidity. What exactly is the plan for the central bank to address that liquidity? I know there was a CRR debit about on Friday, last week Friday, as opposed to doing an home auction, there was a CRR debit, so we might need to pay attention to that. We're expecting more debits in the future when we have home maturities. That was going to happen. Also pay attention to auction calendars. What exactly is happening regarding the auction? Are they going to change? How much is on offer? Are they going to increase? That will give us an idea of where we think yields are going to. And also information regarding borrowing externally. We need to pay attention to that. Conversations have been happening about borrowing some more money externally as opposed to borrowing internally, because that's cheaper and of course it's FX. So we need to pay attention to that. But outside of that, I think it's just...
All right, I guess that's what smart money has to do at this point. Thank you so much. Adedoyin Wilson Diamond, Executive Director, CFG Africa Limited, and also Mr. Paul Alaje right there in Abuja studio. Thank you so much, Chief Economist, SPM Professionals. It's been another one, the 306th meeting, and we have a hold, NPR 26.5%. That holds standing facilities corridor plus 50, negative 450, CRR 45% for DMBs and merchant banks at 16%. So it's the same thing. It's happened, and definitely we'll see how it plays out going forward. So keep your eyes here on our shows. Definitely know what investors should do next and how experts and analysts expect the CBN and the fiscal side of things to manage the economy. Thank you for watching our special today. I'm Ladi Williams from the team right here at Channels HQ. Bye-bye.